One of my subscribers sent me an email recommending that I take a look at this article, and I thought it was really good and I wanted to share it with you today. The article was written from Brendan O'Boyle. It's titled SCHD versus the S&P 500. It's not only about total returns. Now, this video is part of a new series that I create on the channel. Every single Thursday, I'm reviewing articles just like this, and some of them are better than others. And this article is really good. It's not very flashy. It's straight and to the point. And I think if you're investing into SCHD, it adds a lot of clarity and just very plainly explains who should consider investing into SCHD. So I'm really glad that the person reached out and sent me this article because I've never read an article from Brendan O'Boyle before. I just looked at his profile. It looks like he has a PhD from Stanford, and apparently he's a smart guy. And the article was really good. And so if you come across an article that you really like, shoot me an email, send me a message, and I would love to consider the article in a future video just like this. So let's take a look at it. The summary of the article is that the ETF SCHD has underperformed the S&P 500 due to the exclusion of technology stocks. History shows underweighting certain sectors can lead to underperformance. However, shares with substantial growth premium can also underperform in the longer term. Investing in dividend-paying stocks can provide stability even if it means sacrificing the highest possible return. For investors deriving income from their portfolio, this can be a desirable trade-off. SCHD yields nearly 4% on a forward basis, maximizing the chance for a portfolio to achieve the 4% withdrawals over a 30-year time horizon. You know, the things that I really liked about this article is how down to earth this guy writes. There's no fluff in here. He's not trying to write this article for clicks. There's no clickbait in this article, which I really appreciated. And I really liked how plainly he described who should consider investing into SCHD, because not every investment is for everyone. And investing is all about trade-offs. And I think he does a really great job explaining that in this article. One of the things that I wish he would have done different in this article is maybe outlined a few different examples or things that you could consider in addition to investing into SCHD, because I don't believe that anyone should consider investing into one single ETF like SCHD. You just don't get enough exposure to the broad market. But with that being said, that's a little bit nitpicky, just my opinion, but let's go ahead and let's take a look at the article. He starts the article off with saying that recently there have been a number of articles regarding the Schwab Dividend ETF SCHD and its underperformance relative to the S&P 500 or SPY in the past year. In case you're unaware, SCHD is a fund whose goal is to track the Dow Jones US Dividend 100 Index. According to the prospectus, the fund invests in stocks of high dividend companies selected on strength relative to their peers by various financial metrics. These metrics include lower price to earnings and a price to cash flow with higher return on equity and a higher dividend yield. The objectively true point of those critical to SCHD is that the construction of the index it follows necessarily precludes investment in numerous companies, particularly technology firms, which have been among the best performing stocks recently. SCHD does not invest in companies that do not pay dividends or pay very low ones, such as the Magnificent Seven. These are Amazon, Apple, Google, Nvidia, Meta, Microsoft, and Tesla. Now, a handful of those pay a dividend. For example, Apple, Google now pays a dividend, Nvidia pays a very small dividend, Meta pays a dividend, Microsoft pays a dividend, but very, very low. And they're not included into the index of SCHD simply because of how the index is set up. He goes on to say, interestingly, the performance of SCHD has been nearly identical to the equal weighted S&P 500 RSP. RSP invests an equal dollar amount in each company of the S&P 500 instead of an amount relative to market capitalization. Thus, the entire underperformance of SCHD and RSP can be attributed to the minimal investment in the Magnificent Seven. And you can see that here in the graph here that he has here. As an investor who has been active in the market since 1998, perhaps I have a form of repetition bias stemming from the fact that I recall during the run-up of the 2000 bull market when investors underweight technology stocks could not hope to match the returns of the market. Again, leading up to 2007, those underweight financials also had little hope of doing so. However, recent advances in AI have given technology shares a durable advantage, and there is no way to predict how long that may last. I am not attempting to make a bold call on the end of the current bull market or the outperformance of the Magnificent Seven. Rather, the most likely outcome in the near future is its continuation and the outperformance of SPY, or the S&P 500, relative to SCHD. It is typical that mature bull markets favor huge, well-known companies, as these are the stocks typically bought by investors returning to the market after missing years of gains. However, I wanted to add something to the conversation that may be overlooked with exclusive focus on total returns. For investors later in their career who need to draw on their savings in retirement, dividends and consistency of returns can be more important to meeting the goal of providing income over retirement than the highest possible total return. Thus, while a fund like SCHD may not be for everyone, it presents a durable dividend growth fund with high current income. Now, every single boglehead watching this video is just pulling out their hair because the bogleheads do not really believe in anything other than total returns and what's going to give you the highest total return, the total market, everything, right? And so what he's arguing is that depending on the individual and their particular needs and situation, SCHD could be a reasonable alternative to investing in maybe a higher volatile index, or the S&P 500, which is inherently more volatile than maybe a stable, slower growing, dividend focused index like SCHD. Moving on here, the S&P 500 and the 4% rule. Immediately when I see a fund like SCHD, I think of the 4% rule. The 4% rule is a budgeting rule of thumb for investors in retirement. It states that an investment portfolio should be able to deliver 4% of principal for living expenses while adjusting those expenses for inflation. It was popularized by William Bengen in 1994, who stated that under these conditions, a portfolio should survive for 30 years. To consider the risks of such an approach, let us consider a hypothetical retiree. He or she had $1 million retirement portfolio, which was invested in the S&P 500 beginning in January 2000. Each month, approximately $3,300 is withdrawn. This amount increases with inflation by 2.5% each year. So far, by 2024, our retiree needs to withdraw nearly $6,000 per month. Jerome Powell just entered the chat here with transitory. Oh, man. Despite the remarkably poor timing of our investors' retirement, the portfolio still survives. However, its value has been reduced to approximately $600,000, an approximately 67% reduction in purchasing power after inflation. Once again, Jerome Powell has entered the chat. While our hypothetical portfolio should last 30 years, with 6.5 years remaining, it has almost certainly entered a terminal decline. With $600,000 in principal and $72,000 in annual withdrawals, a 14.5% return, 12% plus 2.5 inflation, is required for the portfolio to remain solvent indefinitely. And he has a really nice chart here that he put together himself. Our hypothetical retiree had several challenges. First, the income from an investment in the S&P 500 then as now was very low, just above 1%. Next, the investment was initiated at a time of extreme overvaluation. One useful metric for valuing the S&P 500 is the Shiller PE, which was approximately 42 in January 2000. Presently, the Shiller PE is around 35, which is actually still pretty high. A 20% discount in 2000, but more overvalued than any time since 2000 or in the recent past. Okay, the PE here, for those of you that may not be aware, PE is the price to earnings ratio of the index, and 35 is pretty high. Historically, it should be right around 20, but because the S&P 500 is made up more than 35% of technology stocks, which has never been the case in history, we may need to adjust that historical average up from 20, because as the index gets higher and higher, or, that's just if we accept the new normal of technology, but then you have the reversion of the mean. This is why this gets a little bit funky, but he's looking back on, historical averages, and yeah, based off of this, we're at a lower PE than we were hypothetically in the scenario in early 2000. Moving on, another preferred metric advocated by Warren Buffett is that the market capitalization to GDP ratio. This valuation method compares the market capitalization of the Wilshire 5000 to US GDP. Criticism of this valuation have noted that it ignores factors including, I'm going to breeze through this really quick. This is a little bit nerdy. The comparison of the international companies to the US GDP in 2017, about 44% of S&P 500 revenues come from abroad. It ignores the share of GDP given to corporate profits. This expects mean reversion of margins, while profit margins for the S&P 500 have remained elevated for over 20 years. Ignores the public versus private composition of companies by only considering public markets. Keeping these criticisms in mind, the Buffett indicator still stands at an all-time high of 197%. This is approximately 45% above the 2000 peak and more than double the long-term average of 82%. What he's saying here is using different metrics, different models to measure the how pricey or how under or overvalued we are compared to early 2000 in this scenario. What he's trying to do. What he's trying to do is he's trying to make it apples to apples so that he's not really just cherry picking the data, which I actually agree with. I applaud him for going the extra mile and adding a little bit more clarity. It adds a little bit more trust and authenticity to what he's trying to suggest here. So I actually like what he's doing. The market is aware of the questionable valuation of the S&P 500 because numerous commentators have already made observations of the factors noted above. Similarly to the late 1990s and early 2000s, the market is in the midst of a great technological change resulting in record earnings, especially for the largest companies, the S&P 500. So long as economic growth persists, these companies are likely to outperform. However, there is a high growth premium and should the economy stagnate, the market could yield tepid returns for a long time. Investors with long time horizons can overcome this with time. Since January 2000, investors in SPY or the S&P 500 with dividends reinvested have reaped total returns of nearly 500% and even more if they dollar cost average contributions through bear markets. However, investors needing to draw on their portfolio have the opposite circumstance, and a portfolio requiring a 4% annual withdrawals will, when increased by inflation, have lost 2/3 of its purchasing power since January 2000. Now, this is such a great point, guys. Like, this is what he's like. I love this. I love this article. I'm going to follow this guy after this. Like, this is such a valid point that I had not really talked about on my channel. What he's saying is, if you're a young investor, total returns are really all that matters for the most part, because what he says here, because you have time. You have time to overcome this. If you're paying a premium, if you're unlucky with the timing because the valuations are high and going up here really quick, yes, the valuations are at a historical high. They're not the highest ever, but they are at a historical high. And what he's saying is, if you're a young investor, you can take on the risk to be wrong. If the market were to tank next year or the year after, it's okay because you still have time, and it's even better because you're still adding contributions. Now, on the other end, if you're retiring, this is absolutely what you do not want. And I love that he's highlighting this. I need to incorporate this more in my videos because this is such an important way of how you need to look at this, especially if you're nearing retirement. And that's why, the bogleheads who are not flexible with their thinking and they only are narrow-sighted and they only look at total returns, you can get the timing wrong. And that's why a lot of investors who are nearing retirement, they are willing to sacrifice on total returns for stability and for reliability in their portfolio and their income. All right, moving on, SCHD and the 4% rule. A very desirable feature of SCHD is that the present construction of the portfolio allows an investor to subsist off dividends without selling shares. In addition, due to the lower valuation of stocks within SCHD, there's less growth premium, which should lead to a narrower range of potential outcomes. Whether this particular ETF suits your investment criteria, it is very instructive instructive to know that even as the elevated valuation of the market, it is possible to have a portfolio yielding 4% that has averaged mid to high single-digit dividend growth over the past 5 years. Below are the top holdings of SCHD, which represent at least 1% of assets. These 28 largest positions represent 81% of the portfolio, yielding an average forward yield of 3.84% and a 5-year dividend growth rate of 7.89%. Mwah! Like, unbelievable. Like, that is incredible. That's why, SCHD and chill is a thing now. SCHD and chill. But you want to add a little bit more. You don't want to go 100% SCHD. You can invest in the SCHD and maybe a DGRO, to kind of smooth it out. They go well together. I would not feel comfortable just investing in SCHD, but there's a reason why I don't have 50 individual stocks, and SCHD is one of my largest holdings. A nearly 4% dividend yield and nearly an 8% dividend growth rate. Okay, and also really quick, there are 100 companies in this index. So only 28% of them, a quarter of them represent 81%. It's kind of like that Pareto law, the 80-20 rule. Kind of interesting. So dividends are not guaranteed, but investors should be heartened that the average stock in the fund has grown them for nearly 20 years. All right, let me pull it up here. So if you want to take a look at these all individually, you can pause the video and you can take a look at them. Moving on, the Dow Jones US Dividend 100 Index, on which SCHD is backtested to 1992, providing an 11.28% CAGR, or compounded annual growth rate, with dividends reinvested. Generally, the returns have been remarkably consistent, with the exception of the economic conflagration. This PhD from Stanford is too smart for me. Conflagration. Now I feel like an idiot. Because the index's construction, SCHD is somewhat contrarian in nature. Presently, it is overweight financials, 17%, and underweight information technology, just under 5%. That's why it's not performing like the S&P 500, because it doesn't have an overweight in technology. Every ETF that was underweight, technology underperformed. It's just as simple as that. So moving on here, of the latter sector, the majority of the exposures is in old technology names like Cisco and Texas Instruments, which represent nearly all the tech holdings. So you're not going to get Microsoft, you're not going to get Apple, and I'll say it a million times over, that's why I add DGRO, because you don't get that hyper growth technology exposure in SCHD. That is why I include DGRO. They go better together. It's the simple path to wealth with dividend investing, which was inspired by J.L. Collins, that I talk about here on my channel. So anyways, looking at the sector weighting here, I can't click on the screenshot here, but you can see here financials is the highest, none in utilities, very low in materials, and it just kind of shows, where you're invested. If you invest into SCHD, what parts of the market? Well, I'm not a huge believer in every stock in the portfolio. SCHD provides a diversified dividend growth portfolio in a single ETF. And also, they do a reconstruction every year, so the holdings actually do change, and it's a rule-based index. He doesn't mention that in this article, but that is something very, very important to note, that the ETF changes year over year. In healthcare, I prefer Gilead and Viatris to Bristol Myers and Pfizer. Consumer staples have some interesting entry points, and I've recently been a buyer of PepsiCo and Hershey's. In energy, Chevron is very attractive, and I'm also positive on midstream MLPs such as Enterprise Product Partners, EPD, and MPLX. Personally, I would avoid telecom companies like Verizon, which fund their dividends with heavy debt load. So yeah, I like it. And another thing here really quick, I don't invest into energy stocks directly, but I get a good amount of exposure into energy like Chevron by investing into SCHD. If Chevron does well, I do well. If Chevron does poorly, okay, it's represented lower in the index. And that's why I love investing in ETFs like this, because I don't have to pick the winners. In conclusion, on the whole, it is very heartening that the 4% rule should be achievable for investors with shorter time horizons or those desiring more predictable returns through investing in a portfolio of dividend growth stocks and treasury bonds. This article focused on stocks, but treasury yields north of 4% across the curve, thus blending some mixture of stocks and bonds suitable to achieve stability, growth, and income depending on one's age and risk tolerance is achievable with 4% annual withdrawals. Because the economy is in the midst of a technological transformation, a subset of large cap growth stocks may continue to massively outperform. Younger investors who do not need to draw income from their portfolios have ample opportunities in the midst of recent pullbacks in some of the Magnificent Seven names. Tesla is approaching another buying opportunity since I recommended it at $141 a share and again at $177 a share. In addition, Amazon and Google have pulled back modestly and could be reaching agreeable prices for long-term investors. As an investor in SCHD, I'm happy to expect returns that should provide income and growth to keep up with inflation. However, in the present bull run, the fund should not be expected to outpace the market. The purpose of SCHD is income and stability, not chasing the highest total return. That last sentence there, the purpose of SCHD is income and stability, not chasing the highest total return. If you invest into SCHD, you should write this down on a Post-it and put it on your wall or on your, somewhere where you can see it, just to remind you when you ever see a negative or nasty comment about SCHD, you have to understand your why. Why are you investing into SCHD? Really, really powerful statement there. It's so important. I hope that you understand that. Now let's go ahead and let's take a look at a few comments here and then we'll wrap it up. So the first comment here is, as I get closer to retirement, the goal becomes getting good enough returns while limiting volatility. SCHD is a good component for such an approach. Volatility is your friend when you are young. It's the enemy as you take withdrawals. If my goal was to be the richest guy in the cemetery, I'd never retire and go all in on QQQ. But when I hang it up, I'd like to be able to take my family out to dinner and not sweat whipping out my credit card afterwards. Joey Wong, man, the richest guy in the cemetery. Man, I love that. I love that. So well said. Perhaps someday people will finally understand that investing is not one size fits all. Guys, that's why investing is so hard. When you go and watch a YouTube video or you read an article, you read a comment, and you see that these are the top 10 best stocks. These are the best stocks of June or August. And you just have to understand that those videos, those articles are appealing to a wide audience. Why do you think people love and hate Dave Ramsey? Because he's talking to the masses. He's talking to millions of people. Obviously, if Dave Ramsey were to talk to a specific individual who's completely unique and different from someone else, the talking points may or very well likely be different. But when he's talking to the masses, he's going to give broad, generic advice. And that's what you're getting with a lot of people who are talking to the masses. Even myself, I acknowledge it. When I'm talking to thousands of people watching these videos, I'm talking to the masses. Now, my masses are much smaller than Dave Ramsey, so I'm not comparing myself to Dave Ramsey. But what I want to make the point here is I understand that every single one of you are in a different situation. But I believe that's why I talk about the core and satellite approach to investing, because it provides flexibility and you can mold it. I'm giving you the framework. I'm giving you the blueprint to how to figure this out. And I'm hoping that you take that blueprint and you make it and you form it to your own particular situation. That's why I say the simple path to wealth with dividend investing is investing in SCHD and DGRO as a core portfolio, following the core and satellite. And your satellite positions are there to help you to reach your individual specific goals. If you need more income because you're retiring sooner, well, then you add more higher yielding assets, individual stocks or ETFs. If you have a long-term time horizon, your satellites are more skewed towards growth. That's how it works, guys. And that's why it's so important that there is no one size fits all. Even though I say the simple path to wealth with dividend investing is SCHD and DGRO, but you have to find the mix that works for you. All right, let's take a look at another one here. I believe SCHD works best when you have another investment or two, which includes technology and or growth. I personally am invested in FXAIX growth index for many years and now hold a large position. SCHD is my third largest, and I believe it is a good partner to this other index that you just mentioned. Thanks for the good, sensible piece. Now, this is a really great point. This kind of summarizes what I was just saying with SCHD and DGRO. SCHD is a great ETF as your core, and you add on top of it, you add other ETFs to it that match your goals and your time horizon. So this was the first article that I've ever read from Brendan O'Boyle. I'm actually going to give him a follow, and I'm going to check out some other articles that he's written. So all in all, I would rate the article with an A. I thought Brendan did a really great job on plainly and clearly describing what he was trying to say here, that it's not always about total returns, especially when the market is at historically high valuations, PE ratios. He used the Warren Buffett indicator, and he left the emotions out of it. He doesn't care if you invest into SCHD or if you don't invest into SCHD. What he did is he clearly explained who should and should not consider SCHD as an investment or as an option in retirement, because that's what this is about. It's not about, dollar cost averaging for 20 or 30 years. This is about, is this an alternative to, the traditional 4% rule? And I really liked the article. I'm going to follow Brendan. I think I'm going to read some of his other articles. You can clearly see that he comes from an academic background. He has a PhD from Stanford. What did you think about the article? Do you agree with what he's saying? I hope that you enjoyed the video. As always, everybody, I will be back on next Thursday. Hope everyone has a great week, and I'll see everybody then. Thanks for watching.